A lot of talk here about the direction of yields. They've kind of been holding where they've been for quite some time, but I think we've seen those bouts of volatility over the last few weeks, whether it's on the back of the Fed, the back of some of these earnings reports, or the back of economic data.
Yeah, that's absolutely right, Romain. I mean, I think you're going to continue to see a pretty range-bound market, though, until you get some real movement on the economic front. I mean, the data has been a little bit weaker for sure, but it's been a little bit of a comeback, I think, from unexpected strength to start the year. So the economic surprise index, as Alex mentioned earlier, highlighting maybe a few stress points, but I don't think the market's fully convinced yet that, we're headed towards any sort of imminent recession or anything of that.
What about this idea here that rate cuts might actually be back in play? I know most of the Fed members are kind of reticent to really go down that road because that's all anybody wants to know here. But when you look at the economic data, I would think a case can be made.
I would maybe take the other side of that a little bit. I mean, if you came from Mars and you saw sort of the holistic picture of the economic landscape, GDP now is tracking at about 3%. Inflation is still above 3%, and you're really rolling over easy comps. And inflation could start to see that go up come June. You're probably not going to ask when's the Fed going to cut. Mm-hmm. Now, I'm not saying they're going to hike. I think that would be premature. But with that said, I'm not sure the obvious cases at this point that they're going to cut. Yes, we're seeing normalization from exceptional strength to start the year, but is it really bad data? I'm not entirely convinced, and we're not at 2% yet.
Right, and that's such a good point, because it's normalization versus slowing, right? And they're different things in essence. Are you more worried about growth or inflation than at this point?
In terms of the upside or the downside?
Ooh. If you were sitting on the Fed, which would you be more concerned about?
I would be most concerned about a reacceleration of inflation.
Okay.
I mean, to start the year, we had miss after miss after miss on inflation to the stronger side. As I mentioned earlier, June really marked the lows in inflation. You're going to start to overlap June pretty soon. That's going to cause upward pressure on a year-over-year basis for inflation. And remember, coming into the year, everybody was saying that rent was going to ultimately lead to lower inflation. And what we've seen is the housing market has actually been quite resilient until recently. And so that is also going to continue to add price pressure at the headline number. And so I would be more worried that we're not restrictive enough at this particular point.
So you're more on like the Bowman camp versus the Daly camp in that sense.
I agree with that. And all you have to do is look at credit spreads, look at what's going on with crypto, look at NVIDIA and the Mag 7. I mean, to say that monetary policy is restrictive at the moment, I think is really ignoring the macro data.
Is there, though, a disconnect between what we're seeing in the markets and what we're actually seeing in that quote-unquote real economy? And I mean, this is something that Bowman raised, even Bostic raised yesterday, and I think even Goolsbee kind of touched on it as well.
I think, honestly, I think the markets and the real economy are pretty much in sync. I mean, you haven't seen a big collapse in yields because the data is pretty strong. You have seen sort of more speculative areas of the market recently run because liquidity is still easy. I think this idea that just because the Fed hiked, 500 plus basis points, that all of a sudden that magically means that they're restrictive and things should start to slow, maybe just suggests that the neutral rate is actually higher than what most expect. And so I think actually the markets and economic data are very much in sync right now. Liquidity is not tight enough, the economy is fine, and consumers still spending, and rates haven't fallen because of that. That all seems to jive with me.
How does that fold into the corporate debt market right now? Because we certainly didn't see the movement in spreads that I think some people had anticipated earlier this year.
Likewise. And I think at the end of the day, it all boils down to fundamentals. Fundamentals are strong. Undeniably strong from a corporate perspective. Earnings growth is accelerating. Leverage is, fine. Interest coverage is fine because so many companies termed out their debt during COVID and the immediate following years. The problem with corporate credit, as we see it, is valuation. Valuations just aren't attractive. I mean, 90 basis points in IG, 300 basis points in high yield. Remember, as that yield gap shrinks between a corporate and a treasury, essentially the majority of your return becomes from the risk-free component, not from the credit risk component. So if it's coming from the risk-free component, let's find some better risk-free or close to risk-free assets than corporate spreads.
Before I let you go, tomorrow, PCE, personal spending, income, what are you watching? What do you think you're going to learn?
Listen, I think we're going to learn how, not just tomorrow, but over the course of the next several weeks, we're going to learn how much of this is normalization versus maybe something a little bit more nefarious and a true slowdown. I tend to be, as you can tell, in the former camp, that more normalization, but I think that's what we need to...
What's the signal? So the numbers come out tomorrow and you're like, ooh, normalization or slowing. What would signal that to you?
Something that ultimately ends up much lower than consensus.